let's step back a little bit. And, you are characterized as a value investor. And, maybe, and a follower of sort of the Warren Buffett type investment strategy. What does that really mean? And then we'll dig a little into some of the other stuff that we had spoke about just previously. What does it mean to be, how do you characterize yourself? Are you just another Warren Buffett?
So the dean or father of value investing is Ben Graham, who was Warren Buffett's teacher. And actually Ben Graham kind of, I don't know, people will think this is blasphemy, but Ben Graham kind of led us astray. He led me astray for a long time. And so if we go back to Ben Graham, he got
maybe could you tell the audience who Ben Graham is?
Yes.
They may not know who
Ben Graham used to be a professor at Columbia when he passed away in the 70s. And in the Great Depression and the Great Crash, 1929 to 32, and then all the way to 38, actually, his portfolio got clobbered. And when his portfolio got clobbered, he went back and did a very holistic analysis of how one should invest, where there is very strong downside protection, there is very low risk, and there is a disproportionate upside. And he came up with a framework which was, published in Security Analysis. It's gone through like 7 or 8 editions now, but the Security Analysis is basically the Bible of value investing. And Ben Graham basically came up with this, just 2 or 3 main ideas, which have been the cornerstone of how Buffett started investing. The first is that you're not buying and selling pieces of paper, you're buying ownership, fractional ownership of a business, and you should think of it as if you were buying the entire business. So that's the first mindset in terms of how you should think about buying and selling stocks. The second is that you should insist on a margin of safety. So all companies are worth the sum of all cash they'll produce from now till Judgment Day, discounted by some reasonable interest rate. He said, if you can figure that out, then you want to be buying it well below that price. And the third, which is probably a very important concept, this concept of Mr. Market, where Mr. Market shows up every 15 minutes, every 10 minutes, kind of a manic depressive character. And he's continuously giving you quotes on any business you want under the sun. And your job is to make Mr. Market work for you and not the other way around. So when Mr. Market serves you prices that are way too low, you should be buying, and when he serves you prices way too high, you should be selling to him. And so those were the cornerstones. And because he came out of the Great Depression and 70-80% collapse in indices and so on, he came up with this net framework of buying things at 2/3 of current assets, which would be really, really low, not even paying anything for plant and equipment, net current assets. And if you did that, you would do extremely well, except those types of businesses are very hard to find today. And I think where Ben Graham led us astray is his focus was to buy a business for 50 cents or 40 cents or 30 cents. And then as it approached its intrinsic value of $1, if it had not grown, then you sold the business. So he was very focused on downside protection. And in reality, I think in investing, what happens is you make the most money by investing in businesses which have long growth runways and significantly increase intrinsic value over time. And so, for example, in the Ben Graham framework, if you were an investor in Walmart in the 70s, and if Walmart got up to 40, 50 times earnings, well before that, a Ben Graham type investor would exit. And that would be terrible because kind of miss the forest from the trees. The idea is that if you own great compounding machines, you shouldn't actually be selling even when it crosses intrinsic value, even when it crosses intrinsic value by 20, 30, 40%, as long as the nature of the business is very sound and robust. And so that particular shift, which is holding things above intrinsic value, would be blasphemy in the Graham world. And I, for most of my career, stuck to that intrinsic value being the kind of the red line, right? And I think it was a mistake. And so, but like they say, you get old too soon and wise too late. We finally figured it out, I think 2-3 years ago. And now I have 22 years of runway left before I leave planet Earth. So we still have some room to make amends.